Most investors think market resets begin with a crash. They imagine some dramatic collapse, some obvious red warning light, some giant headline that tells the world a new era has begun. That is how ordinary people picture danger, because ordinary people are trained to notice price before they notice structure. But the biggest resets in markets often begin somewhere quieter. A rule changes, a gate comes down, a friction disappears, and suddenly millions of people who were previously standing outside the casino are invited inside with smaller stacks of cash and a much bigger emotional appetite for speed. That is the mother line. This market reset is not really about day trading. It is about what happens when volatility itself becomes easier to manufacture, easier to monetize, and easier to feed. Most people will hear a phrase like pattern day trading rule change and assume it concerns a tiny subculture of hyperactive traders who stare at charts all day and blow up their accounts in private. That would be comforting if it were true. The reality is much more important once you lower the barrier to rapid-fire speculation. You do not just change the lives of wood. Be day traders, you change the behavior of brokerages, you change options volume, you change the emotional tempo of the market, you CH. That is not a niche shift, that is a plumbing change. And plumbing changes matter because most investors only see the water after it reaches the kitchen floor. They do not see the pressure building inside the walls. For years, the pattern day trading rule acted like a crude but useful gate. If you wanted to buy and sell the same stock repeatedly in a single day using margin, there was a line you had to cross, roughly $25,000 in the account, enough capital to signal that you at least had some cushion before you started playing speed chess with your own money. It was not a perfect rule. It did not stop people from gambling in other ways, but it created friction. And friction matters. Friction is one of the most underrated protections in finance. Every time the system removes friction, a wave of people mistakes access for edge. That is where the money gets made. Not usually by the person newly granted access, by the system that captures the behavior. Now the rule has changed. The old threshold is no longer acting as the hard gate it used to, and the burden shifts toward brokerage risk engines, margin algorithms, and platform level monitoring. On paper, this looks like liberation. Smaller accounts can participate more actively. People with $2,000 in a margin account can potentially step into a much faster game than before. It sounds democratic, it sounds empowering, it sounds like the market is finally opening its doors wider. It is also a business model. That is the part I want you to understand. Whenever Wall Street lobbies for more freedom in trading behavior, it is rarely because Wall Street became morally committed to your self-expression. It is because more activity is profitable, more clicks, more order flow, more options, more spread capture, more margin use, more data, more customer engagement, more ways to turn impatience into revenue. That is why this reset matters so much. It is not simply that more retail money can now spin faster. It is that the entire financial ecosystem now has a stronger incentive to encourage that spinning. Now, let me make this brutally simple. The average pattern day trader is not walking into a game where institutions suddenly became vulnerable. The average pattern day trader is walking into a game where institutions already know the math. The statistics around active day trading have been ugly for years. The majority lose, not a narrow majority, a crushing majority. That is not because they are stupid. It is because the game is structurally difficult. The competition is faster, better capitalized, less emotional, and backed by tools and experience the average trader does not have. Add leverage, add speed, add social media, add options, and what you get is not democratized investing. You get democratized volatility consumption, and the first big winners are not the traders, they are the brokerages. Think about the structure. A brokerage does not need each client to win. It needs the client to transact. It needs deposits. It needs activity. It needs people to treat the market less like a retirement vehicle and more like an interactive environment. The more often people trade, the more value the platform can extract indirectly through order routing, spreads, financing costs, margin dynamics, lending, premium services, and ecosystem lock. That is why the firms most exposed to this reset are not random. Robinhood is the most obvious example because it did not merely participate in the gamification of finance. It helped normalize it. It took trading, wrapped it in an interface that felt intuitive and immediate, and made the act of investing feel closer to a consumer app experience than a capital allocation decision. That is not an insult. It is a description of design philosophy. Design matters because behavior follows interface. If the experience feels easier, faster, lighter, more rewarding, activity R. That is why a rule change like this is oxygen for a platform like Robinhood. It lowers the mental distance between curiosity and action. It tells a user base already trained to think actively that the old gate is gone and the next level is available. Now, that does not guarantee every dollar flows there, but it does mean the company sits directly in the stream of the new behavior. Wibble belongs in the same conversation, though for slightly different reasons. It has cultivated a more socially interactive trading environment, and more importantly, it moved fast. In market resets, first mover advantage matters, because users tend to cluster where the new capability feels immediately available. The firm that says, "You can do it now," often captures the earliest wave of energy, while slower competitors are still adjusting policy language, margin systems, or compliance architecture. That early flow matters. It is not just user growth, it is habit formation. Once a trader starts building patterns, watch lists, options routines, and emotional routines on one platform, the platform gains a kind of soft moat around that activity. Interactive Brokers plays a different role. It was not born to entertain the curious beginner. It was built with serious active traders in mind. That gives it a different kind of edge. When the newly liberated pattern day trader matures from enthusiasm into tool hunger, they begin wanting more than simplicity. They want speed, analytics, routing depth, execution quality, support for more complex behavior. That is where Interactive Brokers becomes extremely interesting. It may not capture the first emodio. Charles Schwab is another fascinating beneficiary, but in a more diversified way. Unlike the platforms whose identity is more tightly bound to trading intensity, Schwab has multiple engines: advisory relationships, asset custody, broader wealth ecosystems. Yet it also controls tools like thinkorswim, which are tailor-made for the active trader mindset. That means Schwab can benefit from increased trading behavior without being entirely hostage to it, in a rule, change-driven cycle that sort of diversify. Then there is CBOE, which may be the cleanest pick, and shovel play in the entire setup. When ordinary investors hear volatility, they think fear. I often think infrastructure. Every extra option contract, every extra wave of speculation, every extra surge in hedging or directional betting has to travel through market structures. Someone owns CBOE as one of those structures. It does not need to guess which meme stock wins, which AI name squeezes, or which crypto-linked equity becomes the flavor of the week. It benefits from the increase in the activity itself. That is powerful because it sits one layer removed from the emotional story. It is not trying to predict the next craze. And when a rule change increases the amount of traffic, toll booths become beautiful businesses. Now I want to widen the lens because this is where most people misunderstand the full impact. This reset will not hit the whole market evenly. It will hit the gamifiable parts first. That means sectors where narratives move quickly, where outcomes can hinge on headlines, where retail can imagine asymmetry, and where options activity can amplify short-term swings. Biotechnology is one obvious candidate because FDA decisions, trial rumors, and binary event structures already create a natural environment for crowd speculation. Profit technology is another because story often outruns economics there. AI adjacent names, bleeding, edge software, semiconductor momentum trades, and Elector. Then come crypto, linked instruments, and the descendants of meme stock behavior. These are markets where emotional intensity is already the fuel. Add easier day, trading access, and you do not create volatility from nothing. You intensify what was already culturally primed. That is why I think many people are still underestimating what this rule change means. They are treating it like a regulatory tweak. I think it is a volatility accelerant. And volatility accelerants do not just create winners, they create victims. That is the ethical complication sitting underneath the entire story. If you open the gates wider to active speculation, more people will get involved. Some will have success. Most will pay tuition. That tuition does not disappear. It becomes revenue somewhere else in the system. This is why I keep saying the market reset is not just about opportunity. It is about redistribution. Money will move, but not all in the same direction. This is also why I reject the simplistic good news framing. More access sounds good, more freedom sounds good, but freedom without edge is often just exposure. And exposure in a high-speed market gets expensive very quickly. A person may now be free to place 5 trades a day without tripping the old pattern, day trader rule. But that does not mean they have suddenly acquired discipline, process, or a statistical advantage. It only means the fence is lower. That difference is everything. Now let me explain why this is still such a powerful opportunity for the investor who is not fooled by the first layer of the story. You do not need to become the day trader. You can own the businesses that benefit from the day trader. That is the pivot. Whenever the crowd gets invited into a more speculative regime, you have 2 choices. Join them at the table and hope you are one of the rare survivors, or step back and ask which companies, which exchanges, which platforms, which infrastructure names collect value from the increase in activity, regardless of whether the average participant wins. That second path is usually better. It is less glamorous. It is more rational. And over time, rationality tends to age better than excitement. This is why I think the real opportunity in this market reset is not the obvious viral stock of the week. It is identifying the collection system around the new behavior. Robinhood if gamified retail volume surges, Webull if first mover retail activity compounds into sticky engagement. Interactive brokers if serious active traders deepen their tooling needs. Schwab if increased participation lifts both activity and deposits, while the firm's broader model provides ballast. CBOE if options volume, hedging, and derivative churn rise across the ecosystem. Those are not identical bets. They are different ways of owning the picks, shovels, and toll roads of a more speculative market structure. Now let me say something very clearly. This does not mean you buy them blindly. Every one of these businesses still has valuation risk, execution risk, and cycle risk. A good thesis at a stupid price can still lose money. A structurally advantaged business can still disappoint. A rule change can take longer than expected to alter behavior. The first earnings print may not show the full effect. User growth may come before monetization. Monetization may come before market recognition. This is not a cartoon. It is a setup. And good setups still require discipline. That means watching what actually matters next. User growth, trading volume, options volume, margin balances, customer activity metrics, guidance language, deposit flows, engagement metrics. This is not a time to be lazy about evidence, but it is absolutely a time to recognize the structure. That is what the average investor misses over and over again. They wait for the evidence to become obvious in the price, in the headlines, in the consensus narrative. By then, much of the easy move is often gone. Institutions and faster capital do not wait for full confirmation. If the plumbing already changed, they start positioning when the rulebook changes because they understand that structure leads story. And story leads crowd behavior. That is what is happening here. The rulebook changed. Now behavior will adapt, then revenue will show up, then the market will tell a cleaner story about why these names deserve to work. That is the sequence. If you want my plain Buffett version, it is this. The biggest market reset in 25 years is not a mystical event. It is a shift in who gets to speculate, how easily they get to speculate, and which businesses make money from that change. The average person will focus on the most exciting stock being thrown around online. The smarter move is to study the rails, the brokerages, the trading tools, the exchanges, the infrastructure beneath the craze. Because in finance, the biggest fortunes are often made not by joining the stampede, but by owning the toll roads. The stampede has to use. That is what this reset really is. Not a day trading story, a money flow story. And if you understand that early, you do not need to gamble with the crowd to benefit from what the crowd is about to do.